Hi, and welcome to the first quarter review and outlook. My name is Dan Timotic, and I'm a managing principal and one of the portfolio managers at T2 Asset Management. This short video is designed to explain and provide some context on what happened in the first quarter and how I'm positioned going into the second quarter. For those of you more interested in a comprehensive and detailed outlook, you can access my second quarter outlook video titled How to Navigate an Aging Bull Market by clicking on the link within the email you received, or simply go to YouTube and search Dan Timotic. That video will give you a deep dive into my four-part framework, as well as provide some ideas on how to structure a portfolio to minimize major market drawdowns. As always, if you have any comments, suggestions, or difficulty accessing my videos, please send me an email to dtimotic@t2asset.com, and I'll be sure to follow up with you. Before we get started, I just wanted to have this disclaimer. This video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers at T2 Asset Management. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, let's get started with the first quarter review. As some of you may know, my investment thesis last year was predicated on reduced regulations, pro-business policies, tax reform, and overall fiscal stimulus. We didn't see any volatility in 2017, and while volatility was expected to pick up in 2018, I think the level of volatility came to as a surprise to many people. After a great start in January, as this chart here is showing, we did see the market just collapse in a relatively short period of time, and we saw volatility kick in at significant levels. So why the drop? There's no single answer in my opinion, but there are a number of factors I think sparked the sell-off. First, we had just come out of a strong 2017, and many large investors had to sell some of their equity positions to get back in line with their targeted allocations. Second, economic data had been strong, and many had feared the new Fed chairman would be more aggressive in raising rates this year. Third, the 10-year Treasury rate had spiked to over 2.8%. That forced stock valuations to adjust. And finally, there were a lot of leveraged derivative products that were betting on at low volatility, and once that volatility kicked in, it forced a lot of those leverage products to unwind, sparking a much bigger sell-off in the market. Thankfully, it seems that the correction was relatively short-lived, and while it was a roller coaster ride in the first quarter did end with slight losses. S&P 500 was down just over 1.2%, and it's something to keep in mind. This is the first time that we had a negative quarterly return since the third quarter of 2015. So even though we had a roller coaster of a ride, we ended the quarter relatively unscathed. Now, while we are looking at and talking about the stock market, and the media was pretty much just focused on that, in the meantime, the bond market did worse than the S&P 500. This is a chart of the Barclays Aggregate Bond Index, which is a measure of the broad bond market. And as you can see here, it wasn't quite as volatile as the stock market, but clearly it was just completely negative all quarter, and it ended the quarter down almost 1.5%. Now, on average, people should expect the stock market to have 10% type corrections on an annual basis. That's kind of how it's been played out. Unfortunately, we haven't had many of these in the recent months, so when we saw this happen at the end of January into February, for obvious reasons, people were concerned. But as this chart shows, and by no stretch do I want to minimize this drawdown, but the reality is that when we touched the February low, we jumped right off of that low pretty quickly and then retested it 2 more times. And the good news, if you will, is that the retesting of those February lows did hold, and it indicates to me that the market is not quite ready to roll over yet. So let's put this recent drawdown into a little bit more context and put it in perspective as it pertains to some historic downturns that we've experienced in the past. I took a look at the SPY, which is an ETF that tracks the S&P 500. I took a look back over the last 8 years or so to see how these drawdowns were affected and what the net result was after they happened. And as you can see by this, we've had a number of them. And each of those drawdowns over the last several years had basically showed a positive one-year return immediately following that drawdown. So in 2011, we had some concerns over the Eurozone crisis. That resulted into two major drawdowns, and yet the market was up over 20% a year later. In 2012, we had the presidential election. We also had a fiscal cliff that was looming upon us, and yet the market recovered over 30%. In 2015, China's economy was slowing and oil prices were falling, which caused two big drawdowns, and again, the market rebounded nicely. I'm not saying that you should ignore these drawdowns completely. What I am saying is that in order to understand the situation, you really need to put things in context, and we're going to cover a little bit more of that later on in the presentation. So, major markets, sectors, really across the board, everything was negative. The S&P was down, the Dow Jones Industrial Average was down, the ag, treasuries, just a pretty tough quarter to get any positive returns. There were a couple of bright spots. Consumer discretionary sector as well as technology had positive quarters. Going into the quarter, I was overweight industrials and materials. This chart here shows that materials were down 5.6% and industrials were down 1.4%. Fortunately, I sold out of materials and industrials at the end of February, early part of March, and the negative returns and the big rollover in those sectors happened after I was already out of those positions. So all in all, a tough quarter for a number of these sectors, but there were some bright spots that we could look at. As far as adjustments to the portfolio in the first quarter, as I mentioned, the industrials and materials overweight that I had going in was taken off. I maintained an overweight to technology. The overweights in materials and industrials, once I removed those, I added exposure to the international sector as well as to existing positions in small and mid-cap stocks. As far as fixed income is concerned, I had an overweight to investment grade and high yield credits. I continue to maintain an overweight to those. I prefer to own credit risk in today's environment as opposed to interest rate risk. I don't think you're going to get paid a lot to go to take on duration risk, so I prefer to have shorter term exposure in fixed income in general. All of these adjustments did help the different strategies that I manage, so we're going to continue to maintain those investment grade and high yield credits. Now, moving on to the four-part framework, I want to touch a little bit more in detail on this, but the four-part framework that I implement is really a way to look at the current environment, both from markets perspective as well as from a macroeconomic perspective in totality. Some people may be interested in only looking at valuations or the economy or earnings or markets, but the reality is each of these particular components have have their strengths, some of them have their weaknesses, and if you're only looking at one of them, you could be sorely disappointed in what you see, and if you're only basing your investment decisions on those, you could be in for some real surprises. But just like a car, going from point A to point B requires not only having an engine and transmission, you need gas, you need tires. Similarly, in investing, you really need to look at all four components. You need to know what the economy is doing, what earnings are doing, how much you're paying for those earnings, and what the markets are telling you and how they're behaving. So when you take a comprehensive view of all four of those components, I think you're going to be in much better shape to navigate through the ups and downs of the market. All right, so what does our car look like today? As far as the economy is concerned, I'm very optimistic and very positive on the economy. We have lower taxes, we have higher wages, employment is strong, we have reduced regulations. All of those things are going to be very, very beneficial for consumers and businesses. Especially since 2/3 of our economy is really based on consumer behavior. It's important to understand how the consumer is positioned and what their net worth looks like and what their balance sheet looks like. I think the current fiscal policies that have been implemented are going to be pretty beneficial for consumers. And as far as businesses are concerned, I think the reduced regulation is definitely going to be helpful in addition to the lower taxes. Moving on to earnings. Earnings are positive. As we're doing this video, we're at the beginning of earnings reporting season, and thus far, the earnings that have been reported are extremely strong. Earnings per share continues to grow. I expect that to continue throughout the earnings season, and positive guidance has been terrific from a lot of these companies that have already reported. There will be additional stock buybacks, I believe, in the event that repatriation of capital from overseas does start to take hold, and all of these things are just a net positive to earnings per share. On the valuation side, stocks aren't cheap, but they are justified as long as the earnings come in at the clip that they're coming in. Forward PEs of the S&P 500 are somewhere around 17, 18, depending on what estimates you're using. The trailing ones are much higher than that. They're probably more around 21. But if earnings do come in at the levels that they've started, I think those earnings are easily justified. I mean, the stock prices are easily justified, and it could propel us much higher. Bond spreads as well are holding up very well. We see credit spreads are still tight. We don't see much widening in terms of high yield spreads, so that's a very positive situation as well. The one concern I do have is that interest rates are rising. We're seeing the 10-year trying to get up there to the 3% level. I think if we do cross over the 3% level at some point, if ever this year, then I do believe that there's going to be some pressure on stock prices, so we're going to keep a pretty close eye on interest rates in general. As far as the markets are concerned, I think they're here I've got it down as neutral, but I think they're pretty positive for stocks. They're not so good on the bond side, and that's why I kind of put a neutral level on markets. Volatility did pick up, and it picked up in a big way, and yet stocks still held up, and they continue to hold their uptrend. So that's a very good things to see. As far as the bond market, though, the yield curve does continue to flatten, and it's something that you want to pay close attention to. Whenever the yield curve flattens to zero or inverts, it's an indication that we have some economic problems in front of us. It's not an immediate concern, but it is something that we want to keep an eye on. Now, the markets always have tailwinds and headwinds, and in this case, it's no different. Some of the tailwinds that I think are going to help the markets are going to be the lower tax environment as well as reduced regulations. Both of those are going to be positive for businesses and for consumers. That's why I like to have exposure to small and mid-cap companies. The repatriation of capital from overseas is going to be additive to earnings, or to earnings per share, I should say. Either companies are going to go ahead and redeploy that capital into capital expenditures and investments, or they're going to use that to buy back some stock. I believe there'll be some sort of combination between the two. Either way, it's going to be a positive for stock prices. As far as headwinds are concerned, geopolitical risk is one of the things that we always have when it comes to financial markets. It's something we can't model, and given what had just recently happened with the bombing in Syria, North Korea, Iran, Russia, China, you can name it. There's always some sort of political risk that we need to be aware of. At this time, as long as the rhetoric starts to die down, and it appears that it has, at least in the near term, we could probably expect that geopolitical risk is a little bit on the lower end. But again, nothing that we can model. We just got to pay close attention to what's going on globally. As far as trade wars are concerned, I think those are just completely overblown. I do think that there's going to be some negotiations with regard to various trade deals, but the fact of the matter is we've been in trade wars for quite some time. The EU imposes significant tariffs on U.S. products. China has always imposed significant tariffs on U.S. products, and yet when the United States starts to talk about imposing some sort of tariffs, then the world goes crazy. But I do think that level heads will prevail, and I think that negotiations will continue, and I just don't think that there's going to be much of an escalation in terms of trade wars. The aggressive Fed, that could potentially still be a headwind, as long as if inflationary pressures do start to increase significantly, there is a possibility that the Fed could be a little more aggressive in terms of raising rates. At this point, I don't see them doing more than 2 more this year, particularly because fiscal policy has finally started to meet up with the accommodative Fed stance, and I think that the Federal Reserve is reluctant to really stifle economic growth and expansion just to raise rates. So I think 2 more rate hikes this year, unless we see some sort of real significant inflationary pressures or problems. Now, what should you do? We talk quite a bit about portfolio segmentation, and I'm a firm believer that you need to allocate your investments across different buckets of risk. I do that for my clients. This particular chart here demonstrates how I do that. I have 2 different pockets of investments. I have a long-term allocation, which is predicated on my 12 to 18-month outlook. I think going beyond 18 months is a futile exercise. It's very difficult to predict what's going to happen 2 to 3 years from now. But at this time, barring any sort of recessionary factors or indications, I'm going to try to stay as fully vested as I can. And right now I do have a fully invested position in my long-term allocation, all predicated on the risk tolerances, and that is what I consider my core holdings. On the right side, we have a short-term allocation, and that's a pocket of money that I try to, or pocket of the portfolio that I try to rotate across different markets globally, sectors within the S&P 500. It gives me the flexibility to hold cash, bonds, stocks, some alternatives. This is where I'm trying to take advantage of shorter-term opportunities that occur, something with a 3 to 6 month type horizon. So what do I like going into the second quarter? I like, in general, stocks over bonds. We talked about the interest rate risk and how stocks have been performing and how resilient they are. From a stock-specific market cap, I like the small and mid-cap stocks, primarily because of the reduced tax reform bill, as well as the reduced regulations. International stocks are cheap relative to the S&P 500, and I've recently added a position to that. My overweight to technology is still continuing, even though valuations on a trailing basis for that sector are on the higher end. I do expect earnings for the tech sector to be strong for the first quarter once they do report, so I'm pretty optimistic on that. On the fixed income side, I continue to like high yield credit. I like credit in general over interest rate risk. High yield bonds as well as floating rate bonds, both on the investment grade side and the high yield side. The things I don't like in second quarter 2018 is interest rate risk. Long duration bonds have a significant amount of interest rate risks. If you take a bond with a 10-year duration and interest rates move up 1%, that bond's going to lose approximately 10% in value. And I don't think there's any reason for investors to hold long duration bonds in today's environment, given how flat the yield curve is. I think the give up in yield to be on the short end of the curve is worth it. The curve is just too flat to take on that interest rate risk. On the stock sector side, utilities, REITs, and staples, those three sectors are interest rate sensitive as well. And so those are three sectors that I wouldn't particularly have an interest in. So when we look at the markets and overall, I think we're in pretty good shape. I think as investors, we do have to make sure that we're maintaining a high level of discipline when it comes to the markets because of the emotion that comes with investing. I understand that people have feelings when it comes to the financial markets, but those feelings need to be controlled. Emotions are a very powerful thing, and they can lead you to make very poor decisions. You know, when things are bad, investors will turn to the internet to confirm their fears, and when things are good, they're going to search out information that's going to confirm their feelings. It's kind of like going to WebMD and diagnosing yourself. If you're looking for a disease, WebMD is going to help you find it. You know, I've been in the investment management business for almost 25 years, and I can tell you this much, people really haven't changed much. So one way to kind of eliminate, or I shouldn't say eliminate, but reduce your emotional decisions is to do what we do here, and that's portfolio segmentation. It allows you to allocate certain dollars to risk buckets, and it also allows you to be aggressive in a portion of your portfolio, as well as play defense in another portion of your portfolio. And then most importantly, while some people like to look at only the economy or earnings or valuations or markets, each of those components has their strengths and each of them has their weaknesses. And I think it's very important that you look at all four of those in totality in order to paint a better picture of what's going on, not only in the markets, but also globally from an economic perspective. And then finally, implementing an investment strategy that's going to help you reduce some of your emotion and your stress. You know, the financial industry for far too long has been preaching about a buy and hold strategy, and they tell you that you need to live through the ups and downs since you're a long-term investor. But you know, the reality is that we are going to have recessions in the future. We are going to have deep major drawdowns in the markets like we had in 2008. And if you lose half of the value of your portfolio and you're approaching retirement, you're just not going to have the time to recover from those disastrous kind of events. So it's very important that you understand what the investment strategy is that you're employing and what investment strategy your advisor is recommending for you. So with that being said, I really want to thank you all for watching, and please email me any comments or suggestions you may have. You could also feel free to share this video with your friends, family, and colleagues. And don't forget, you could get the more detailed second quarter outlook by simply clicking on that link in your email or searching Dan Timotic on YouTube, and hopefully you'll take the time to go ahead and do that. Have a great quarter, and we hope to see you next time.